When you contribute money to certain tax-advantaged investment accounts in Canada, like the RRSP and the FHSA, you have the ability to reduce your taxable income by the same amount that you contribute. But let's back up for a second. The RRSP, or the Registered Retirement Savings Plan, is a tax-advantaged or registered investment account that was created by the Canadian government. Now, the goal of the RRSP is to incentivize Canadians to invest for retirement. And the way that they incentivize us to invest for retirement is by offering different tax benefits. And the main tax benefit for this specific account is that it's tax deferred. What that means is that you can reduce your taxable income by the same amount that you contribute. So if you put $10,000 into your RRSP, then you can reduce your taxable income by $10,000, saving you money in taxes. Then you end up paying taxes on your money when you withdraw it from your RRSP in the future instead, likely when you're retired and you're making less money. Now, like I mentioned earlier, you can do the same thing with the FHSA, or the First Home Savings Account, which is another registered or tax-advantaged investment account that was created by the Canadian government. This specific account has two main tax benefits. You can reduce your taxable income, and it's tax-free, so you don't have to actually pay taxes on your contributions in the future either. So if you contribute money to either one of these accounts, the RRSP and/or the FHSA, then you have the option to reduce your taxable income. Now, the reason that I say you have the option to reduce your taxable income is that you can either claim your deductions, so reduce your taxable income, in the year that you contribute to your RRSP and/or your FHSA, or you can defer your deductions to the future and claim them in the future instead.
So Steph actually started contributing to both of these investment accounts, so the RRSP and the FHSA, for the first time last year. That means that during the most recent tax season, when she went to file her 2024 tax return, it was her first ever opportunity to reduce her taxable income. We recently shared a video that broke down what that experience was like for her, and in that video, she talks about how she had 3 different options with the money that she contributed. Number 1, she could claim the entire amount and reduce her taxable income by as much as possible. 2, she could claim part of the amount and partially reduce her taxable income. Or 3, she could carry forward the entire amount and not reduce her taxable income at all. Then, spoiler alert, she broke down why she decided to claim the entire amount and reduce her taxable income by as much as possible, instead of carrying forward the entire amount and not reducing her taxable income at all. But we never really covered option 2, claiming part of the amount and partially reducing her taxable income, and if and when that might be the right option. So it's time to do that now. In general, reducing your taxable income is in theory the most useful when you're in your highest income earning years, because that's when you owe the most amount in taxes. Again, we know that you can defer your RRSP and FHSA deductions and claim them in a future year, so you actually don't have to contribute money into your RRSP and your FHSA when you're in your highest income earning years. And when it comes to the FHSA, it likely wouldn't make sense to wait. Instead, you can contribute money into these accounts at any time and defer your deductions to the future to make them as useful as possible from a tax savings perspective.
Okay, so let's explain exactly what we mean when we say from a tax savings perspective. And in order to do that, we have to explain how our tax system works and then run through a few examples. So in Canada, we use a progressive tax system with marginal tax rates. So that means that you pay more taxes as your income goes up. So people that have a higher income are meant to pay a higher percentage in taxes. Now, our tax rates are split up into tax brackets, which are basically just like ranges of income. So I'm gonna run through what our federal income tax rates are for 2025. So if your taxable income is $57,375 or less, then all of your income is taxed at 15%. If your taxable income is between $57,375 and $114,750, then some of your income is taxed at 15%, and the amount that's over $57,375 is taxed at 20.5%. If your taxable income is between $114,750 and $177,882, then some of your income is taxed at 15%, some of your income is taxed at 20.5%, and the amount of your income that's over $114,750 is taxed at 26%. If your taxable income is between $177,882 and $253,414, then some of your income is taxed at 15%, some of your income is taxed at 20.5%, some of your income is taxed at 26%, and then the amount that's over $177,882 is taxed at 29%. And finally, if your taxable income is over $253,414, then some of your income is taxed at 15%, some of your income is taxed at 20.5%, some of your income is taxed at 26%, some of your income is taxed at 29%, and the amount that's over $253,414 is taxed at 33%. All of that means that when you make more money, you don't jump up an entire tax bracket. Instead, only the portion of your taxable income that's above the limit for each tax bracket is taxed at that higher rate. To give you a clear example of that, if you had a $70,000 taxable income, then $57,375 of that would be taxed at 15%, and $12,625 of that would be taxed at 20.5%. So now let's show you what contributing to your RRSP and FHSA and actually choosing to claim those taxable income deductions would work. So new example here. If you had a taxable income of $50,000, then the entire amount would be taxed at 15%, meaning that you'd owe $7,500 in taxes. But if you contributed $10,000 to your RRSP or your FHSA and you claimed that entire amount, then your new taxable income would be $40,000, and you'd owe $6,000 in taxes instead. That's a $1,500 deduction, meaning that you've saved $1,500 in taxes. And if you've already been paying your taxes throughout the year, then it means that you'd get a refund. Now, the thing to keep in mind is that all of this is happening inside of the lowest tax bracket, meaning that you're seeing the smallest possible benefit from these RRSP and FHSA contributions.
So let's look at another example. Let's say that you now have an income of $70,000. That would mean that $57,375 of your income would be taxed at 15%, and $12,625 would be taxed at 20.5%. The $57,375 that's taxed at 15% would lead you to owing $8,606 in taxes. And the additional $12,625 that's taxed at 20.5% would lead you to owing an additional $2,588 in taxes. That's a total of $11,194 in taxes owed on this $70,000 income. But if you carried over that FHSA or RRSP contribution and instead claimed it this year when you have this higher income, then your new taxable income would be $60,000 instead of $70,000. Then the $10,000 contribution gets deducted from your highest tax bracket first. So your $57,375 at 15% stays the same, but your $12,625 taxed at 20.5% now becomes $2,625 taxed at 20.5% instead. That means that your new taxes owing for that tax bracket would be $538, leading to a total of $9,144 in taxes owed on this new $60,000 taxable income. That's a $2,050 deduction, meaning that you've saved $2,050 in taxes. And if you've already paid your taxes throughout the year, you'd get a refund. You can see that by waiting until you have a higher income, and specifically one that's in a higher tax bracket, can help you save more money. Your same $10,000 turned into $2,050 in savings instead of $1,500. Now there's a few things to keep in mind here. The first is that this is a very straightforward example. In reality, you likely would have continued to contribute more to either your RRSP or your FHSA during the next year, so you'd have even more than $10,000 to claim. The other is that there's also the opportunity cost of waiting to claim your deductions. Even though your $1,500 refund turned into $2,050, you lost out on time that your money could have been invested in the market. That was Steph's line of thinking when it came to claiming her deduction now. She's going to be investing the vast majority of that refund. So that's at least one full year of time for her money to be invested in the market and capitalizing on compound growth. And we know that time in the market is key for long-term investing. So let's explore her specific scenario a little bit more.
So in my case, my original taxable income in 2024 was about $70,000, but I'd also made about $50,000 in contributions to my RRSP and my FHSA during the 2024 tax year. So let's adjust the numbers on that last chart to show you roughly what my math was looking like. And keep in mind that these are close to my real numbers, but not exactly the same. And it's also only factoring in my FHSA and RRSP contributions and not my entire tax situation. Okay, so you can see that the taxable income is now $20,000, and that's the original $70,000 taxable income minus the $50,000 in contributions being claimed. And that entire $20,000 is all under the 15% tax bracket, of course. That means that the taxes owed were reduced from $11,194 to $3,000, which is great. That's $8,194 in tax savings. But now I want to compare this to two other different potential scenarios. The first scenario is if I waited to deduct these contributions until my income was higher. And let's specifically say when I hit an income of $100,000. Now, if I did that, so held off on claiming the $50,000 in deductions until my income hit $100,000 instead, you can see that I'd end up with $9,844 in tax savings. So it's an additional $1,650 in tax savings overall. Now that shows that in this scenario, holding off on claiming your deductions until your income was higher did benefit you from a tax savings perspective, like we mentioned earlier. But in our line of thinking, I'm very likely going to benefit more than $1,650 $2,650 by having my money invested in the stock market during that time that I would have been waiting for my income to go up to $100,000. In my case specifically, Dennis and I run our own business, and we aren't projecting that we're going to raise our taxable income to that amount within the next few years. Even if we can, we probably won't to save money on taxes. So if my taxable income ever does grow to $100,000, it's likely not going to be in the next year or two. So that means that I'd rather have my money invested in the stock market now and growing over the next few years instead of waiting to receive an additional $1,650 in a few years. Now, in your scenario, it might be different. Maybe you know for a fact that your income is going to be substantially higher next year than it was this year, so it might make sense to hold off on claiming your deductions until then. And again, that might make sense, but if you're holding off on claiming your RRSP and your FHSA deductions for an unknown or extended period of time, then it could actually be more beneficial to reduce your taxable income now, specifically if you're going to be investing that refund that you get. It's not more beneficial if you're going to be spending your savings, only if you're investing them.
Now let's move on to the second scenario that Steph mentioned, which is if she deducted a partial amount this year, specifically only the portion that was taxed at 20.5%. So in this scenario, she would reduce her taxable income by $12,625, which is the amount that's in the next tax bracket, which should lead her to only owing $8,606 in taxes, meaning that she would have gotten a $2,588 tax refund. In this case, she only claimed $12,625 of her $50,000 contribution, meaning that she would have $37,375 left to carry forward and claim in a future year still. If her taxable income stays the same, she could continue to claim $12,625 worth of her RRSP and FHSA contributions. She could do this for another 3 years from the leftover $37,375 alone. And then she'd be continuing to contribute to her RRSP and her FHSA every year too, at amounts that are higher than the $12,625. That means that she could continuously receive a $2,588 tax refund for many years to come. We have two thoughts on this though. The first is that Steph's still likely going to be able to reduce her taxable income by the $12,625 per year for the next few years. She plans on maxing out her FHSA and RRSP for the next 3 years, hopefully as long as things stay the same, which will be $8,000 plus at least the additional $4,625 to hit that $12,625 amount. So she doesn't need to have $37,375 left over. She can claim the entire amount this year and still get fully below the second tax bracket over the next few years. She kind of gets the best of both worlds, having a bigger tax refund this year and investing that money as soon as possible, and still being able to reduce her taxable income over the next coming years as well. Keep in mind that all of this is reliant on the fact that we don't expect our incomes to go up substantially over the next few years. So we'd rather have our money invested instead of sitting there just waiting for us doing nothing. If your income will go up substantially over a short period of time, then it might make sense to partially claim your deductions. In general, we like the idea of focusing on your TFSA first when you're younger and in your lower income earning years, and then moving on to your RRSP.
Okay, so the last thing we want to touch on is how it actually works to defer or claim your contributions on your tax return. It's actually a pretty easy process. So with whatever tax filing software that you're using, there will be a section where it asks you how much you want to claim from your RRSP and how much you want to claim from your FHSA. So basically it separates out the two. For me, I filled out the RRSP deduction and the full amount that I could claim from that account. And I also filled out the FHSA deduction and the full amount that I could claim from that account. Those two amounts were then added together and deducted from my taxable income. If you didn't want to claim anything, then you'd fill in $0 for both the RRSP and FHSA deduction. Now, if you want to claim a partial amount, then you'd fill in the amount that you do want to claim from each account. So for example, if I did do a partial deduction of $12,625, then I could have, again, just for example here, filled out $8,000 for the FHSA, so that's the max amount that I could claim for that account, and then an additional $4,625 from the RRSP to get up to that total amount that I wanted to claim. And that's it. After you finish filling out and filing your tax return, you'll receive your tax refund, if applicable, based on the amount that you did claim. We really hope that you guys found this breakdown helpful, and if you have any questions on all of the different stuff that we covered, make sure you ask away in the comments down below. I also wanted to mention that we cover this topic in depth, really go into detail on how you can use the RRSP to its full potential in our investing course called Simple Investing for Canadians. So make sure you check that out and sign up if you're interested in getting even more information on that process and how it works. And also if you want access to us to answer all of the different specific questions that might be specific to your situation as they come up. With that, we'll see you guys next week with a new video, and have a great rest of your week.